Is everyone ready?
Yep, we're ready.
All right. So, Seminar Zero, The Basics of Investing by us.
So what is investing? So when you hear the word investing, there's always something to do with money, and that's true because investing involves committing money in order to earn a financial return. So I'm going to make it simpler. So it means you're putting money down and your goal is to make money and achieve your financial goals. But that is a dictionary definition. However, I want you guys to keep in mind that don't confuse savings and investing because investing is more associating and putting your money longer times in a riskier way, such as if you buy a stock and you hold on to it for longer periods of time. I would call that investing. If you're day trading, that's more speculation. Josh, go back. And because it's different because and investing is more riskier than a savings account. Do you know why? Because savings are guaranteed. Your money is there. You won't lose it. But investments are not because investments, it's possible that you can lose all your money, but it's possible that you'll make more money because that is the risk of investing because there's always a balance between risk and reward. Next. So between savings and investing, so I'm going to talk about differences. So when you have $20,000 in 30 years, and what would it look like if you leave it for 30 years? Okay, let's talk about under the mattress. If you leave $20,000 under your mattress, there's no interest, there's nothing. But if you leave it in your savings account, you get interest, which is when the bank pays you money to leave money in your accounts, because the bank can use that money to go loan it out to someone else. With that 2% interest which compounds, which means that the interest will earn interest as well, would be 36,337. Just look at the difference. Just putting the money under your mattress savings, there's already a significant $16,000 difference in 30 years. But however, investing brings it to another level. So using the 5.48% annual return, so that is the average how much the market has, the overall Dow Jones market, so the American stock market has went up per year for the past 30 years. That is an average number. Using that average number, because in the long run, usually in the States, stocks still go up. That is the trend of history. I don't know about the future, but that's it. So when you put your money like that, the 5.48% annual return, $20,000 in 30 years is $99,000. So almost 5 times the amount of money. So you can see the difference of how your returns and how compounding. So the difference between how everything can go up exponentially instead of how just stays the same if you put your money under your mattress.
All right, so now that we know the difference between savings and investings, we can look at the different types of investings. So investing, there's actually many different strategies of investing. So one of the first and some of the most popular way of investing is investing in stocks. So what a stock is basically a share of a company that anyone can buy. This investing strategy is relatively high risk and a relatively high reward. So for example, there's a Tesla stock, which market price right now is $430 US dollars. And if I buy it right now, it won't go up that much, but it won't go down that much. So it's a relatively safe, actually not relatively safe, but you gotta understand your own risk and understand the high reward.
Yeah, and I'm gonna add on something is that every stock is different and it has different risks, like such as one of the stocks that I like to buy is Aurora Cannabis. That stock has went up over 160% over this weekend. Right now, it went down, the total today went down over 40%. So that is what I would call high risk stock. But a low risk stock would be something like Boeing. Like Boeing has been literally dead at 160. It has stayed there constant there for the past few months at that spot.
All right, thank you. So another type of investing is real estate. So real estate is just involves purchasing properties such as apartments or houses or townhouses. The only problem with this type of investing is that it's a high barrier to entry because a typical property here in Richmond, say like a detached home, is $1.5 million. So you would need at least a down payment of $200,000 to get a mortgage to buy that home. So, but then there's also the upsides, which that it's a medium risk, medium reward investing strategy. Because real estate prices, as long as you're not in some sketchy area, as long as we're in some good area like Richmond, the prices won't fluctuate too badly, right? So for example, a townhouse in Richmond in 2016 cost around, what was it, $700,000?
Around $1 million, I would say.
$1 million? Yeah, around $1 million. And then now it's still around $1 million or $900,000.
Yeah, the market overall, like on a long run, real estate market still goes up pretty steadily. It's just there still is going to be some ups and downs, like such as the highest point in our Vancouver Richmond real estate market was 2016. So after 2016, the lowest point was it went down in 2019 around 15% down. But then it's not as volatile as stocks where overnight it could even possibly go down 80%. That won't happen with real estate, most likely.
We have a question from Josh Wu. What is an example of a bad area?
So one thing I'm going to talk about, one thing.
Go ahead.
Okay, I think a bad area, what he's meaning is, the thing about real estate, location is very important. A bad area would be something like a place of high crime rates, a place that has bad feng shui, or somewhere that has like it's inconvenient. Those is what is a bad area. And yes, as Harkit said, the hood.
Yeah, it's the bando. So like an example of that could be Victor, like Surrey, I'm guessing.
Some parts of Surrey, I would say, that would be considered as a bad area because of the high crime rates over there. It is worrying, but then it's factored into the price, I'll be honest. If it has a bad area, the price is cheaper for a reason. East Hastings and Maine is a very sketchy area as well, but it's convenient, so the price there is still pretty high.
Yeah.
Yep. All right, moving on. Another type of investing is bonds. So what a bond is a loan that you give to the government with interest. A bond has very, very low risk, and therefore it also has a very, very low reward. So an example of a bond could be the US Treasury bond, which at market rate, it's a 1.6% return in 30 years, which honestly, it's not that good. But then if you want to have a low risk investing strategy, then bonds is your pick. All right, more types of investing. So there's another type of investing is a Forex, or more commonly known as foreign exchange. So it involves exchanging one currency for another. It's lower risk than stocks and lower reward than stocks. So for example, if I want to trade Canadian dollars to US dollars, I just trade at the market rate. One Canadian dollar is 77 cents US dollars. So with this type of investing, the volatility isn't that high. The risk is also not that high, but then therefore the reward isn't that high either. All right, so the next type of investing, mutual funds, which is basically an investment program funded by shareholders that trades in diversified holdings and is professionally managed. It has, depending on the mutual fund you buy, it has the risk depends on the mutual fund you buy, very much like stocks, and therefore it also depends on the reward. So for example, a mutual fund could be the S&P 500, which right now is $321. But then since COVID hit, I think it's been down like a good 20%. Correct me if I'm wrong, Victor or Andrew, but I feel like it's been down around 20%. Yeah, so more or less, yeah. So you got to take those into consideration. Right? And last but not least, one of my favorite types of investing is cryptocurrency.
Excuse me.
Which involves buying digital currencies such as Bitcoin or Ethereum. So my recommendation for everyone out there is that it's very high risk, very, very, very high risk, but then there's also a very, very high reward. So for example, in Bitcoin, one day Bitcoin was at 12,000 US dollars. The next day it drops to 4,000 US dollars. That's basically like, 70% decrease?
Yeah.
And then the next day, the very next day, from 4,000 US dollars, it jumps back to 20,000 US dollars, which is a 500% increase. So for yeah, sorry.
Oh yeah, I wanted to add something in, is that Bitcoin is also very, very volatile because of the nature of the Bitcoin, because unlike money, Bitcoin has no central bank backing it. So it's less control. The price of it is completely determined by supply and demand in the market.
Yes.
Yes.
And to invest in cryptocurrency like Bitcoin, you have to prepare yourself, because, like Josh said, within one night you can lose your entire life savings, but then the next you can double it.
It has to be money that is disposable. Like if you lose it, you lose it. Like that kind of money, not like money that you need to buy dinner for your family.
Yes.
Smart investing.
Of course. So if you do want to invest in cryptocurrency, it's better for you to do your research. If you do want to put a good amount of money into it, just be prepared for the worst. Yes. Don't get your hopes too high. Yeah.
Yes. Yeah, so the basics of stock investing. So in stock investing, there's a few things that you have to consider. Is that, first of all, it's risk and reward. So you always have to consider your risk management strategies. Is what you want to risk. Like if you're willing to lose all your life savings, but in return, you're hoping that you can make a bunch of money, then you would invest in something such as like cryptocurrency. Like this is about how much risk you're able to take on. And also, stock picking. So in the stock market, in North America, there's 3 biggest exchanges. So what an exchange is where those companies go and list themselves, say, I'm for sale. So one of them is NASDAQ, so that's US. That is mainly more tech stocks. One is the NYSE, so the New York Stock Exchange, that is in the States as well, in New York as well. And one more is a Canadian one, which is the Toronto Stock Exchange. So that is made for Canadian companies. So in of those, you can choose out of thousands of stocks of which one. You can analyze it yourself, and it's to pick which ones do you think will go up in price, what stocks will go down in price, such as let's say Tesla. Why Tesla will go up? Possible, you could think of market factors, economics. So an important thing about stocks, you have to be very wary of what's happening in the world right now. So such as Biden, who is presumed to win the presidency right now. That was a factor that may make you think that the stock would go up. So that's probably a reason why you would buy the stock. Diversification. Also, when you're putting in a portfolio, don't put all your eggs in one basket. So what that means is that don't dump all your money in one stock. Do you know why? Although sometimes that stock may go up a lot, you make a lot of money, but then the risk is much higher, because if one thing happens to, let's say, Tesla, then all your money, you lose a bunch of money. Yep. So risk versus reward. Okay, so this is something that I really want to explain in detail, because usually stock market goes up, but most of the time, a lot of people end up losing their money because of risk, because stock market is something that's risky. You always have to be careful, and you always have to, when you're putting money in, you have to expect it has to be money that you don't like, money that you're okay with losing. And there's always a trade-off between risk and reward, especially in the stock market. Because, let's talk about why investors invest. Because they hope that they'll make money by investing their money. But in return, they're taking the risk of losing their money. But then with that risk, they're hoping the stock would go up, because that is the balance between risk and reward. So for example, I bought a stock that was extremely volatile. I'm bearing the risk that it might go down or might go up 40%. Next day, it drops 62%. But the day after, it goes up 87%. So I'm taking the risk that it might go down a lot, but in return, it might go up a lot. So talk about investments that carry less risk. So less risk, there's always a lower reward. So that's like bonds, savings accounts. Such savings accounts, you get paid 1%, 2% interest. In return, you are risking that the bank may go bankrupt. But those chances are so small. And that's why that the amount of money and reward that you're getting back, so the interest is that much low as well. But investments that carry more risk, there's potentially higher reward, such as let's talk about options. Options, I'm not going to go in depth, but options are extremely volatile. Next day, it can go up 126%. Or it can go down 99.9%. And stocks, well, stocks something that higher reward because the stock market is extremely volatile, such as with the COVID-19 crisis in the first few days in March. That's when the market went down almost overall 30%. And that's the risk that you are taking. Because in this world, there's no such thing as a free lunch in this world. You must be able to take some risk and bear that risk in order to get some return, because no one would just hand you a wad of money if you're taking no risk.
All right, next we'll be talking about stock trading in Canada. So to, like Victor has said before, to buy and sell stocks, you need to do it through a broker. And there are some examples of like online brokers that you can buy and sell stocks. With each of them, they would have either a fee for currency exchange fee, or a like just like a fee to buy each stock.
Yep. Destiny, your question, what's a broker? So a broker is someone that helps you buy that stock. So you can't directly, with the stock market, the stock is listed on a stock market. So then you have to have someone to go buy that stock for you. You can't call up the exchange and say, hey, I want one share. You have to have a bank that does it for you. It can be a bank, a company. So as Andrew said here, Questrade, TD, BMO. TD and BMO are both banks. They help you go buy that stock. You put your money in that account. You say, I want 10 shares of Tesla. They'll go over to the exchange and say, and make a transaction for you, 10 shares of Tesla.
It's a third party that handles all the exchanges for you.
Yep.
There are different account types, which includes cash, margin, TFSA, RESP, and RSP accounts. And as us minors, we cannot open a stock trading account. And if you want to open your own trading account, you have to ask your parents, and if they would let you open an account under their names.
Yeah, and I'm going to go in depth about the cash margin account. So a cash account would be where you put your own money in and then you invest in it. But in a cash account, you have to pay taxes. So then the government will charge you. So it's like you put on your tax return at the end of the year and you pay taxes accordingly. And you only have to pay half the amount of taxes though, because it's an investment. Margin account is where you have the right to borrow money from your bank to do it. But that's extremely risky because you can lose a lot of money and have a lot of debt as well. A TFSA is a tax-free savings account. So every year, once you turn older, the government gives you around a few $1,000s that you can put into an account that's for investing. You can do a savings account, you can do stock account. And in that account, whatever investment you do in that account within your limits is you don't have to pay taxes. RESP account is for your education savings plan. An RSP account is where you can buy it for your retirement savings plan. You'll get some tax discounts on that. Yep. Next. So I want to talk about inflation. So in my opinion, I think money to measure your net worth is actually something that is very, very inaccurate, because every day money becomes less valuable because of the buying power of what you're able to buy. Think about it. 10 years ago, if you had $100, I could buy 100 McDonald's burgers. Now, $100, I can maximum buy 50 McDonald's burgers because your money is getting less and less valuable in comparison to the goods and services you buy. Such as you go to a restaurant, every year you go, there's going to be some type of price increase. So your buying power of your money becomes less and less valuable. So that's why investing is so important, because it helps most of the times it helps you grow that money and counters the effects of inflation. Just leaving money under your bed doesn't mean 10 years later if you leave $20,000 under your bed for 10 years, 10 years later, your $20,000 isn't going to be as valuable as it is right now. Yep. Next.
And to finish off today's seminar, here are some tips to investing. So, we'll start off with avoiding lifestyle creep. So what lifestyle creep is when you get like more wealthy, you would feel like the luxury before in the lifestyle you had before would be a norm because you have this amount of money more than what you had before. So for example, like luxury foods, designer clothing, jewelry, and etc. And so basically, just because you can afford it, it doesn't mean you have to have it. Staying true to a lifestyle that is only comfortable, not luxurious to you. Second, start investing. You can invest with daily change that you have in your wallet, or downloading a app that rounds up your spendings, like by saying you spend $3.61 buying a coffee at Tim Hortons. The app would round it up to $4, and then you would have that 39 cents put away for you. So you could like day by day would add up, and then you can use that money to invest. Third, you have to understand the risk you're taking. Like we've mentioned before, understand the risk. If you're taking high risk, you should be expecting potentially high reward. But if you want to take less of a risk, you have to keep in mind that your reward would not be as high as the higher risk that you did not take. Fourth, diversify your investments. Like we've also mentioned before, do not dump all your life savings on one stock or one type of investment, because if, say, one day this stock drops 70%, then all of your money would be gone, and then you would be broke, in debt, etc. So when you diversify your investments, even if one part of your investment does not do well, you haven't lost everything. You can still make a comeback. And lastly, invest for long term. It has studies have shown if you were to hold on to a stock for a long term, it's more likely for you to actually get a reward out of it. Say Victor buys a stock, and then on its first day it goes down 30%, but he doesn't want to give up, and then he just keeps on holding on to that stock. But later on, not like theoretically, okay, next week it goes up 160%. There he is making money, instead of if he were to like give up and sell at when it's 70% down.
Yeah, and also I want to add on that as well, is that this is a recent experience of myself. I bought a stock, I'm not going to say which one. I bought it, and then in a week total it went down 40%. So $10 per share went down $6. Recently, I held it for a few months already, and now it's already near $20 per share. So long term wise, like even if you're looking into years, there's lower risk and a potentially higher potential return right there.
But there's also a scenario where your stock just keeps going down and down and down, and then there should be you should have a point of where you're is it like I cannot lose more money. So you have to set that point for yourself so you don't end up actually losing everything.
Yeah, you should always, in my opinion, if you're investing long term, is you should always have a price, a floor, and a ceiling. So once it rises to some price that you're satisfied with, sell it. Once it drops to some low point that you want to keep some of your money, so then dump it. Just stop the loss, stop the bleeding. Yep. Okay, so thank you so much for joining our first seminar. So next time our seminar we'll go in depth more about stocks, and then we'll talk about real estate. Any questions from anyone?